Hey guys, welcome back to the Donis Brothers channel. My name is Kerwin.
And this is Kenneth Donis.
This is Jeffrey Donis.
And we are the Donis Brothers. Kenny's always dramatic with his entrance.
You have to be. You have to be. It's Friday.
Yeah, it's still Friday.
It's good on Mondays.
Yeah. Yes. Today we're talking about how you can fund your real estate deals. That's something that I think a lot of people, when they get into real estate, there's this misconception or like they have a limiting belief that they don't have the money, they can't get into it. Only rich people can get into it that have generations of money. And we definitely don't have generations of money, and we were still able to get into it. So there is a way to get into real estate and get your first deal and fund it. And you can get creative with it. And we're going to talk a little bit about each option and kind of just leave you some resources where you can go and pursue that further, whichever one. And you just want to learn all these strategies and kind of test them out. Feel free to do it. But this is not financial advice, and always consult with your CPA or financial experts before
making an investment
action.
decision.
Yes. So that's just our protection. But without further adu, let's get into it. Step one, I guess you could technically get a loan out, right? If you can qualify for a loan, and we are not experts on that. But I will say, do you guys understand like how to maybe approach that at the beginning?
Get like a loan from the bank?
Yeah, like what advice would you give someone when they maybe want to get their loan?
Yeah, I would just say like one thing I would do if I was brand new was go to networking events in person. There's free ones all the time, depending on where you live. But you can meet a lot of mortgage lenders there. You can meet a lot of private money lenders, hard money lenders, and build relationships with them. At the end of the day, they're going to invest money. If it's like a hard money lender, they're going to invest. They're more likely to invest with you if they know who you are. And maybe they won't invest with you today, but let's say in a year after you've done some deals, just the bigger network that you have of these people that are willing to give you money, maybe the more competitive terms you're able to get, which inherently will mean the more money you're able to make.
Yep. And the reason they would give you less attractive terms is because you're more of a risk. But if they know you and they like you and they trust you, then they're probably going to be more willing to help you out and not be as strict with those. Jeffy mentioned private money. Private money, it's essentially money that's it can be raised from different people, but typically it's a wealthy person who has a lot of maybe retirement funds or just has a lot of money, and they will provide that money. And typically you're investing in the asset. So let's say you want to do a flip. Private lenders, they'll provide the funds for the flip. And a lot of times it's contingent on the actual flip and the investor's track record. So if they have like an extensive track record of doing flips in the area, and the investor, the private money lender is impressed and believes they know what they're doing, then they're more likely to want to lend to you. So if you don't have any experience, that could be a potential like downside. Do you guys have anything to add on private lending?
Yeah, and private lending is not necessarily like a professional lending. Like you can go to friends, families, family, and just say, hey, I found this property. Just tell them the numbers and then tell them how much money you need. And, you can pretty much get money from people that you know. Now, there are some people that you build relationships with that are maybe doctors or lawyers or just high-end, corporate guys that just make a lot of money but don't want to do the flipping themselves.
Yep.
And that is where, obviously your cousin will probably lend you money easier than a doctor or a lawyer that you don't really know will. So, yeah.
Yeah, and we have an episode by the guest was Alex Brashears on our Real Estate Monopoly podcast, and she talks about being a private money lender, what she looks for in investment opportunities, and how she vets the investors that she gives money to. Another option is hard money, and I have the definition here. It's used for short-term loans, and it's not always the most attractive option, but because they're typically higher interest rates, and so of course that will hurt your cash flow. And it's often for shorter periods. So let's say like 6 months to a year is typically how long you'll get the debt. And it's popular for flippers because flippers typically only plan on holding the property for around that time. So it might be a good option. Of course, there's some drawbacks to it, but if you can meet the qualifications, and it depends on the lender, what the qualifications are, but that is an option for you as well. When it comes to syndications is what we do. Can you guys touch on other people's money? So using OPM, of course, if you have money in your bank account, it's always an option to use your own money. Typically, you'll use that as like the down payment for a loan. If you have enough for the entire loan, then I guess you could use your own money, and it's less risk. But you can also use other people's money. Can you guys define what that is?
Yeah, I mean, what we do is you're just bringing on investors, whether that's, I think OPM serves in any case that you're not using your own money. It could be a bank, it could be a private money lender, a hard money lender, or if you're syndicating, then it could be your passive investors. But at the end of the day, you're using someone else's money to go and do something. In real estate, it's typically buying property and or doing something with the property, and then you're going to give them a return based on how much they lent you and what your initial terms were.
Yep, exactly. And so what is a syndication? Just briefly discuss that.
Yeah, it's when you syndication is when you pull together a group of investors' money to go buy something, and you can actually syndicate anything. For us, like when we hear syndication, I think apartments. We're gonna go buy an apartment, but you can buy anything with just a group of investors' money. Actually, we were at an event, and I was at the event. They weren't there, and they were talking about people syndicating parking lots. You can syndicate like car washes, literally anything that produces some type of income, because that's how you're going to be able to give the people you're raising the money from a return. You could syndicate.
Yep, 100%. And so there are some benefits to using your own money if you have that. One of our friends knows an investor who owns tons of units, thousands of units, but he owns them all outright. And there's benefits to that for sure. You have more equity, which means you get more of the cash flow, and you also have more control. And it's, just less people in the seat. And if you're the main owner, then it's your property. You can kind of do what you want with it. What are some of the cons to using, to go back to the other people's money? What are some reasons you might want to use your own money over someone else's money? What are some cons of that?
Yeah, like you just said, you'll get more equity if you're buying the property without using anyone else's money, because you're the only person that's putting money in. Therefore, you get all the return. Also, you don't have to deal with, like, if you were to get and use other people's money, you're going to have to deal with that other person. Typically, if in our case, it's a long-term relationship because we're holding the property for a few years. So anything that comes up, if it's say that something bad happens, it's not only your money, but you also are putting their money at risk. So it is a big responsibility, and that comes with good and bad things that you're going to have to deal with. And at the end of the day, these people that you're in a long-term relationship with, you don't want that to go bad. So there's a risk of that relationship maybe going south if the deal goes south, kind of thing. Yep. So there's so many different things, but there's obviously benefits to it, and that's why we do it.
For sure. And when you use a lender, they're typically, if they're giving you the majority of the money that you need to finance the property, then they're going to be your biggest investor. And so that's a relationship, like Jeremy said, it can be very, very messy if things don't go well, and they have control because they have a majority of the equity in their deal. So they have the most skin in the game. What are some cons of using your own money though? Like, let's say you have the money, it's an option for you to pay for the property 100% or the majority of it being your own money. Why would you might be hesitant to do that?
Yeah, well, I mean, just using other people's money, you don't obviously put your own money at risk, and although that might sound bad, yeah, I mean, it's true. I mean, large corporations, they might have billions of dollars just sitting liquid, but they're still going to go and take out debt because then they can use that debt to make more money, and they're not using their own money. So I just pretty much leveraging other people's money to make money. And you have, I mean, yes, I guess you have a responsibility to it, but you're using their money to make money. And I think that's really like the biggest upside to it, because you're not really in, I guess.
And to clarify, it's a big responsibility regardless of whose money you're using. If you're not using your own, then it's definitely a bigger responsibility, and we like to think that you want to take more care of their money than you would your own. But what I think we kind of was also trying to say was, like, you stretch out your money and the power of your money if you're also bringing on other people, because we also do put money in our own deals, but we're obviously not doing all of the equity. We're going to raise it so that way we can buy more, a bigger property, because obviously some of these are really big and you can't afford it by yourself. But if you raise the money, then you're able to afford it. Also, we're giving these people an opportunity to invest with us. So they're getting, I don't know if we're going off topic, but like they're getting access to deals that they would never have been able to get access to if they didn't know us. And if we didn't show them, hey, this is something that you might want to look at. So I think there's different cons and benefits, but that's obviously we do it for a reason. And I think there's a lot of benefits to it.
For sure. Another thing is you're able to scale your portfolio much more quickly if you're using other people's money, because there is a limit to what you can, to the amount of money you have at that moment, but there really is no limit to how much money you can raise. Of course, with following the law and the SEC guidelines, which is a whole nother topic, but there's really no limit to how many people you can meet and build relationships with and raise capital from. But there is a limit to how much money you have in your bank account. That's more fixed, I would say. So if you wanted to scale your portfolio and add to your properties, add more units, then raising more capital is a great way
you diversify your risk. If you're able to buy 3 properties with like $2 million, you're able to put a little bit in each, and everyone else is also diversifying their risk if they're also doing the same thing, versus me just going to buy one property and putting all of that $2 million into one. Say that one goes bad, I lose all of it. But let's say 2 out of the 3 do well and one of them goes down. Unfortunately, I lose a little bit, but it's definitely diversified across 3 properties. Yep. And I think that's a benefit as well.
That's a great point. Great point. And so we talked about private lenders. If you're in the single family space, you'll typically, that's the main way you'll be raising capital is from private lenders, I would say. And so if that's the case and you're looking for a private lender is just somebody like a person who, it could be different sources, but a private lender is typically somebody who doesn't want to do the investing themselves, but they have the capital to do it and they still want, to be involved in real estate. So different ways to find a private lender. You can find them on social media. I have friends who have connected with people that were interested in investing. And it's also a great way to learn more about real estate is if you have your money in it, the investor might hold your hand and kind of walk you through the process and show you how they do it, how they do their flips, for example. So that's one option. You can also, like Jeffrey said, go to local networking events and meet them in person. Even if it's a flipper who maybe doesn't have time to handle another flip, but likes that area and you have the deal, they might be willing to fund your deal. We've had somebody do that with us, right? Where they kind of acted like a private lender where they funded our deal and they were the flipper and we kind of just oversaw the project.
Yeah, exactly. And that was interesting because we didn't actually we put money in the marketing, but we didn't actually put any, well, I guess that's getting the game, but we didn't actually go 50-50 on the expenses to flip the property. But we did participate in the profits, and I guess the value we brought was finding the deal, which is a lot of value.
And Kenneth oversaw the whole process, and he went out to the property. So the private lender was more hands off than he might have been on his own flips.
Yeah, but it comes to show you that you don't necessarily need money all the time. That's not the only currency.
Yeah. And do you guys remember how we met him?
That he was one of our cash buyers, right?
Yeah.
So that's from wholesaling.
I sold him a good deal that we probably could have made good money on, but we didn't flip. And he made great money on it. And so, yeah.
Comes to show you the power of not thinking transactionally, but thinking long term. And then that guy actually introduced us to someone else who was in the multifamily space. And now hopefully we'll do a deal with him one day. But it just comes to show you it's a long term play.
Yeah, absolutely. And so potential investors in a private lending standpoint, I just wanted to touch on maybe what they look for in a good deal so that we can help people kind of determine like if they should even approach a private lender with this deal. What do you guys think?
Yeah, I mean, I think it's the same way that anyone should look at a deal, right? I mean, they're investors, but they may not be like the person doing the project and handling the day-to-day. They're still at risk. They're going to analyze it the same way. But I would say the main thing they look at is you as like the person who's going to do the deal. They're going to vet you. They want to know your track record, your experience. And so I have had some people that like I've heard say, it's not only your track record, although the terms will look a lot better for them if you don't have a track record. So sometimes they're willing to loan out money to new people, but they're going to want to, make it more beneficial for them because they're taking on more risk. But the better your track record, then the better the terms. Now, some things that we look at when we're doing a deal, it'd be the same as them. It'd be the market, the numbers of the property, what like ARV is, if it's a single family property, how much work it's going to need. They may need to look at like the pictures of the property just to see the condition. And then also, I don't know exactly if they look at like who is going to be doing the work exactly, if it's going to be you or...
I'm sure they look into that for sure. Depending on the private lender, they're going to do their own due diligence and they have their own due diligence process that they go through to make sure that their money's safe and as secure as it could be in a real estate investment. So I just really quickly also wanted to talk about what maybe you should look for in a private lender and what kind of relationship you might want to have before accepting their money, or should you just accept anyone's? What advice would you give?
Yeah. Well, what I would do is go and get a referral from someone else that I know. So like say that Kenneth has been doing a lot more flips than me in this area and I'm new and I need a private money lender. I'd ask him and ask him how were they throughout the transaction. I'm sure Kenny's done a lot of deals. So like he's probably had some that didn't go as well as he thought they would. How did that lender act in that case? And kind of just learn more about that relationship. Because, I mean, why would you go? You could just go and find a random person, but that's taking a risk on, like, not liking the person. And if you're taking their money, it's not going to be fun if you don't like them. And it could just not go well.
Yep.
So maybe just by having a referral, that's what I would do.
Yeah. And it seems like, networking, building relationships with people, just explaining, pitching deals to potential private lenders. These are all kind of encompassed with having good sales skills. So I would say it's really important to have good sales skills. And Ken McElroy, he's the author of...
It's McElroy, sorry.
McElroy. Ken McElroy, sorry.
McElroy.
Ken
McElroy.
Ken McElroy talks about how sales is really important. He says sales solves nearly every problem. And I think that we can relate to that. Relationships and just knowing how to communicate with people is super important. Robert Kiyosaki, who is up there on our chimney, he talks about how all entrepreneurs need to be good in sales. And he says that if you can raise capital, that's one of the best skills you can have in general. So that's why it's really important to do that. And what are some good resources for learning that? I don't know if we already talked about that.
For learning how to
either raise capital or just sales skills in general.
I mean, I just actually went to an event like 3 weeks ago. It was by the real estate guys called How to Win Funds and Influence People. It taught me a lot about sales. And I think it's at the end of the day, sales can get applied to anything you're trying to do, especially how to raise money, because you're trying to not necessarily sell them, but you are trying to sell them the investment that you're trying to get them to invest in. So sales skills does apply to that. It applies to wholesaling. It applies to selling it to a private money lender if you're trying to fix and flip.
Everything. Yeah, everything. Now, finally, I did want to touch on some creative options for funding your deals, because it doesn't always have to be using actual money in the sense that you might think. So that will lead us into the creative financing industry or space in those strategies. There's two that we have learned and we typically have we used in the past. It's a subject to financing and seller financing. So you can each take one, but can you both define what each one is? Maybe just explain what it is, break it down.
Yeah, seller financing is when you we got one of each. So I'll explain seller financing and I'll let Kenneth do the subject too. We had a condo or something. It was either the condo or the house. Condo. We got it under certain terms. So what you do with the seller is I called her and was like, hey, I can't meet you at your price, but would you be willing to sell it to me on terms? And she was like, oh, cool. What's that? And I said, well, I can give you your price. Let's say she wanted 50 grand in theory. And I was like, I can't give you that cash, but I can give that to you on terms, meaning payments. So she was going to actually act like the bank, where let's say we're going to pay her $500 a month over 10 years. I don't know if the math works out that way, but let's say that adds up. And would be negotiated 0% interest and no down payment. So she was going to get her money, but it wasn't going to be all today. It was going to be over time, as if you were paying a bank. Now, the reason that we do that is because we can go in and rent it for more, and we knew that we could do that. So in theory, let's say we could rent it for about $1,000. If you do the math, let's say after expenses, you're cash flowing anywhere from $300 to $400. That's a good deal for us because we were in it for no money. Mm-hmm. So as soon as you take over, obviously some renovations, but over time you would make your money back.
Yeah, and you can also, the benefit to the sellers that they actually might be able to receive more than their property is worth because they're willing to take payments over time. So it's like that's why they would do it, is because they're getting more over time. Or at the end, they're going to be getting more. Now, Kenneth, can you just briefly explain what subject to financing is?
Yeah, so subject to, basically you're buying a house and you're taking title to a property or a house or whatever it is. And you're leaving the loan or the actual existing loan under the seller's name. So you own the property, but you don't own the loan, and you're obviously responsible to pay it on their behalf, but you're not liable for the loan. Mm-hmm. So basically we just, for one of the properties we own, seller house was sitting vacant and he didn't really want it anymore, but he couldn't sell it because it was, in the condition it was in, it was just not worth the amount that he had on the loan. So we took over the loan, just paid our attorney to just transfer the title, but that was $600 or maybe even $800. And then we turned around and obviously just were able to rent that. But the reason someone would do that is because in this situation, the house wasn't worth enough to cover, or if they were to sell it, they would not have they would have to have came out of pocket and paid, a majority of the loan off. Mm-hmm. Other reasons, maybe people just don't want the loan, or so that's the benefit to him. We can cover the mortgage payments with the cash flow, with the rental income we're getting from the tenant. So Pace Morby is a great option if you want to go learn more about that and those creative strategies, and that has helped us build our rental portfolio in the single family space. But
If you guys have any questions about anything we discussed today, let us know. If we can't answer it, then we will help you by pointing you in the direction of someone who can. So yeah, let us know. Connect with us on social media. Jeffrey, where can they find us?
You can find us at Donis Brothers on all platforms. You can follow me at Jeffrey Donis on all platforms. Check out our website, www.donisinvestmentgroup.com. And then make sure to visit our free 5 mistakes that passive investors make at www.donisinvestmentgroup.com/playbook.
Yep, and you can check us out on
Our podcast.
The Real Estate Monopoly podcast. So let's get out there, take action. I hope you guys have a great rest of your day.
Have a great Friday.
Make sure you click and subscribe.